It's wonderful to be back on this forum where we have people from such diverse backgrounds. Even thematically, we have people who approach topics from economic, from political, from international relations. And that's why this forum over the years has emerged as such a formidable platform to present ideas and to discuss. So I'm very delighted to have my fellow panelists here. The topic is when economics is political. And of course, it's a wonderful topic, except as a full-time economist, I wonder if economics is ever apolitical, except perhaps in the classrooms or the way we teach economics. From the Indian point of view, our economic policy has very much had a political objective as well, which is that in the last 11 years, while we have maintained good and fast economic growth numbers, what is lesser known and perhaps less appreciated globally is that 300 million people have been brought out of poverty. And these are numbers as per the Rangarajan Committee, which is a metric we use for poverty, which doesn't just include food, therefore hunger. It includes housing, it includes healthcare, education, conveyance. Hence, it's a moderate, it's a good metric. And even by that conservative metric, India has done phenomenally well on the larger political objectives. But while we are happy within our own world, though we are globalizing rapidly, there is a world outside which is in increasing tumult. And I am going to speak to my two fellow panelists on what does it mean in the current crazy times from an economic point of view when increasingly political objectives are weighing down on the way decisions are being made. So I will start with Nouriel. Nouriel, we were very happy on our own, doing pretty well. And now we are faced with a situation which I think started in 2016, if you look at long-term numbers, even trade numbers. But we are faced with a strange uncertainty when we are trying to make sense of the situation. But how much of the economic policy that we are seeing emanating from the US today is political, and how much of it really does have sound economic background?
Thank you. Great pleasure and honor being here. And you're asking a very important question. I mean, I would say there are two sides of it. One is the global, that there has been a bit of a backlash against liberal democracy and democratic capitalism, in part because we went from a world with less globalization the last 30 years to a world of hyper-globalization, with a huge amount of trade in goods, in services, a movement of capital, labor, data, technology, information. And the backlash started initially because there were winners and losers, especially in advanced economies. Working class, blue collars, manufacturing lost jobs. That was the first backlash. The second one was that we had this hyper-globalization and hyper-capitalism leading to financial crisis, both in emerging markets and then with the GFC in the US and advanced economies. And three, now we have a backlash because of geopolitics and because of the geopolitical rivalry between US and China and other parts of the world. Everybody wants to protect their own workers and industries that are considered strategic, and therefore we have the risk of deglobalization, de-risking, decoupling, reshoring, friendshoring, and you name it. So those are the three pushes against the trend of hyper-globalization. Within the US, I think the question that everybody's asking is what will be the economic policies of Trump, whether they'll increase growth or reduce it, whether they'll increase inflation or reduce it, and what are the impacts not just for the US, for the world. I would make a nuanced kind of analysis, because some of the policies of Trump may over time, the good policy lead to higher growth and lower inflation. Some of them may lead to lower growth and higher inflation. And then the question is, what's the balance between the two? I'm not going to be a two-handed economist saying on one hand, on the other hand. I'm going to take a stand on why actually the positive over time might be actually dominating the negatives, even if in the markets today, of course, the concern is that tariffs and other policies may lead to an economic downturn. I'll argue why that's unlikely to happen even in the short run. The good stuff is obvious, is pro-business, and there'll be better business sentiment, more economic activity. He wants to make the tax cuts of 17 permanent. Everything else equal, if you can finance it, lower taxes on labor income and corporate is a good news. 3, he wants to deregulate the economy. Probably after the GFC, we went from a pendulum of laissez-faire to excessive regulation of many parts of the economy, and that's bad. 4, he wants to, increase the efficiency of the public sector. Doge, there is plenty of fat in government spending. There are limits to how much you can cut, but you can cut significant amount. 5, I would say that the most important thing that's going to increase potential growth is that the US is #1 in all the major technologies of the future. It's not just AI and machine learning, it's robotic and automation, biomedical research, quantum computing, fusion as a new energy source, green tech, ag tech, fintech, new material science, space exploration, exploitation, and you name it. These are 12 industries of the future. I would say US is #1 in most of them. China is #2, close to US, but a generation behind, maybe ahead today only in mobility and green tech. And then everybody else in the rest of the world is a distant third, even if many countries can actually be technology innovators, starting with India that has a comparative advantage already in IT industries, and can be actually a hub of innovation in technology, including AI. So the point is that maybe he's lucky, maybe he's endorsing this new technology, but even with a totally dysfunctional political system like US with partisanship, the private sector is so dynamic that by the end of this decade, my estimate is that US potential growth that is today estimated to be only 1.8% is going to be at least 3%, most likely 4%, and it could be even higher. And historically, technological innovations are logarithmic. Growth is a spurt, and then it kind of stabilizes, while we could be in a situation where these innovations are exponential, meaning growth by the end of this decade is 4 rather than 2, by the end of the next decade is 6%. So I believe that actually that's highly likely. So in some sense, the message is you can do many bad things, but technology is more important than all of them. It's first order. Everything else that is bad is second order, meaning tech trumps tariffs. Now, on the bad stuff, of course, what can go wrong? Tariff, trade war, protectionism, restriction to migration, reduce the labor supply of skilled labor, budget deficits that are large because you cut taxes and you don't find enough spending cuts, and you have deficits that become runaway. 4, you could try to disorderly, try to weaken the dollar. 5, you could try to interfere with the independence of the Fed. 6, if you don't have rule of law and you have unpredictability, that's bad for business confidence. So those are the things that can go wrong. Why I think that the things that can go wrong are going to be constrained? 4 reasons. Reason #1 is the most important one, is market discipline, bond vigilantes, stock market vigilantes. If he follows policy on trade, on migration and deficit that increase inflation, bond yields are going to go higher in nominal terms because of inflation, in real terms because of high deficit and debt, and that's going to crowd out economic activity. It's going to lead to even further fall of the stock market. The economy could end up in the recession. That's what he doesn't want, meaning he controls Congress, he controls his party, he controls the Supreme Court, even controls social media because X is owned by Elon Musk with his body. He can control everybody, but he cannot control the bond and the stock market vigilantes. The former political advisor of Bill Clinton many years ago, Jim Carville, once made 2 statements that were important. One is the economy is stupid. That's why Biden lost inflation. But the second most important one is said, when I'm reborn, I don't want to be reborn as the president of the United States or even the Pope. I want to be reborn as a bond vigilante because I can go beat around everybody who's against me and does stupid things. So the most powerful people in the world are bond vigilantes. And what we saw in the last weeks is that bond yields and stock market are going against Trump. That's going to constrain him. Second constraint, Fed independence. If his policy lead to higher inflation, the Fed may even raise rates, and that's going to constrain him. 3, his economic advisors understand economy and market. Scott Bessent, Steve Miran, Kevin Hassett, people like Howard Lutnick. Some of them are extreme pro-protectionism, like Peter Navarro, but it's 1 out of 5. 4 constraint, he has a limited majority in Congress, and therefore a certain policy on trade, he cannot legislate them, even if he controls the party. So the point is, there is good stuff, there is bad stuff, the bad stuff is constrained, and therefore we're going to see an acceleration of noise until April 2nd, of more tariff and other things, but once the market are going to punish him, it's going to escalate to de-escalate. And by the second half of the year, the size of these tariffs and restriction trade are going to be smaller than the initial announcement. Therefore, the economy is not going to end up in a recession. And over the medium term, technology, as I said, trumps tariffs. Because technology is several hundred basis points of higher productivity growth, while the impact of trade and migration restrictions is 10, 20 basis points of a reduction in growth. So technology over the medium term dominates everything else, and US is going to remain the #1 technological juggernaut in the entire world. So on net, I'm actually reasonably optimistic.
Thank you. Now I'll come to you, Amitabh. What do you think from the larger, you've been hemming the G20 conversations? From that perspective, do you think this is a particularly political time, which means that sensible economics or the kind of bigger concerns that we are trying to face as a collective is under greater threat today than it was, let's say, 2 years back?
So, to my mind, 3 critical factors. One is global growth, which is around 3% and is going to moderate to even lower levels, will be the slowest since the turn of the century. So global growth is slowing down. Number 2, you have a conflict going on for over 3 years in the heart of Europe. You had the First World War in Europe, the Second World War in Europe. And so the relative period of stability in the world has come to an end. And the third is that global supply chains are totally disrupted. I mean, you had the Biden administration putting 100% duty on imports of automobiles from China, 50% on batteries, 25% on steel and aluminum, and that was done by the Biden administration. And Trump comes in and puts additional duties on them. So this level of duties is unprecedented. Europe has gone and put another 45%. So what you're seeing is that the global value chains have been totally disrupted. And, when Japan post-World War II, when Korea, later China in recent times, when they were growing at rapid rates, global economy was growing. Global supply chains were expanding in a very big way. So if the third point, and the fourth point I want to make is that you have new productive forces. You have AI, quantum computing, which have the potential to transform lives of people, enhance productivity, improve learning outcomes, health outcomes. These are critical forces. So when it comes to a country like India, which has to grow and expand rapidly for the next 3 decades, if your target is to go from a $4 trillion economy to a $30+ trillion economy, the challenge is we must understand that your GDP has to grow by 9 times. Your per capita income has to grow by 8 times. Your manufacturing has to grow by 16 times. That's the challenge. And these challenges have to be met when global growth has slowed down. None of these countries, Japan, Korea, China, they all grew by exporting and penetrating global markets. So when India's turn to grow has come, you are going to meet these challenges of slow growth. You are meeting the challenge of total disruption in global supply chains. And therefore, economics is totally political to my mind. And therefore, you have to have the huge political will to completely scrap rules, regulations, procedures, acts which India has built up during its socialist era, and allow free enterprise to grow. And to my mind, it will not be possible without unleashing private enterprise and entrepreneurship and free enterprise, which is what the Prime Minister said in the budget. So it's only free entrepreneurial spirit of India which will enable India to grow rapidly and export and penetrate global markets. And all these completely useless socialistic era rules, regulations, and the socialistic mindset of Indian bureaucracy and of economists, many economists, need to be totally undone with. Without that, it'll be very difficult for India to penetrate global markets.
Thank you. I'll come back to you, Nouriel. You mentioned technology as the reason for your optimism, a large part of it. It makes perfect sense to most of us. But tell me, it's also the key driver for growth within China. Except a large part of that technology transfer has happened on the back of trading systems which have not been entirely fair. What do you foresee as the next decade being from the technology front for China, given an increasingly belligerent and insular, I think inward-looking US?
Well, first of all, I think that technology is becoming now intermeshed with geopolitics, because whether you like it or not, whoever is going to dominate the technology of the future, and as I said, it's not going to be only US and China, because India can do well. There are pockets of excellence from Japan, South Korea, Taiwan, parts of Europe, Israel, you name it. So the biggest innovators might be US and China, but this big game is going to be more global. But whoever is going to be dominant in this technology of the future is not going to be only an important economic, financial, trading power, but it's going to be also the biggest military security and geopolitical power in the world. That's what Eric Schmidt, former CEO of Google, wrote a book last year before Eric Kissinger died, with Henry Kissinger, saying that's why there is a great game. Is US and China, but it's going to be bigger than just US and China. And there are some sectors that are now of strategic national security interest. AI is one of them. Semiconductors is another one. Robotic and automation is another one. Defense tech is another one. Energy, especially new forms of energy like fusion, are going to be another one. Quantum, and broadly, even green tech. So we live in a world in which all major power are going to want to have some play into the innovation of these technologies of the future, and that's where the great game is going to occur. You know, China, without technological innovation, is on the path to have a growth rate of only 3%, because you have massive headwinds. One headwind is aging. Population is going to fall from 1.4 to 700 million. You have two parents and one child. When the two parents are gone, then population is going to drop by half. India is the opposite. Population is growing. They've gone to state capitalism under Xi Jinping. They have a burden of debt. They have a burden of real estate. They have state capitalism. They've been until recently bashing the private sector. There are technological sanctions of the US. Export-led growth is going to be constrained by tariffs and protectionism. And savings are high of the household and consumption is low, because the Chinese have to save for old age, where they get sick, where they get unemployed, the migrants who don't have access to public services and so on. So unless they have a big social safety net, savings will remain high, consumption will remain low. So they have all these massive headwinds. So growth was 10%, then 7, then 5 now. By the end of the decade, it's going to be 3 at best, probably even lower than that. The silver lining for China is that they're going to do massive amount of innovation in the technology of the future. As I said, there'll be one generation behind the US, but only one generation behind. That is good enough. And everybody else is a distant third or fourth or whatever not. So probably growth is not going to fall to 3. But think of it this way: if it was falling to 3 and US growth is going to be 4% by the end of the decade, not only US per capita GDP of China is not going to move towards the US or overall GDP, but the actual growth rate of US could be higher than the one of China, something unusual for an advanced economy. So we could be in that world. If they do innovation, they can increase productivity growth, and that's going to happen. The problem with China is that if you increase the production of high-tech goods, whether it's electric vehicles or autonomous and green tech and chips and you name it, and then you don't have enough domestic demand, you're trying to dump it in global markets. But that's not acceptable, not only to the US and Europe, but I've been many times to India, I've been to South Africa, I've been to Brazil. I mean, even the Russians are saying we don't have our manufacturing destroyed by Chinese cars, and the Chinese, friends forever are dumping all the stuff even in Russia. So the point is the global south cannot accept a situation where China's share of global manufacturing is 30% and is rising. So either the Chinese become production of high-tech goods and services, but they have a domestic demand for it, or otherwise they're going to face massive protectionism, and then they'll have deflation, they'll have economic downturn. So that's the key problem with China. It's not going to be increasing the supply side, on which they'll be good, they'll be even better than they've been in the past, but how to create domestic demand. If they create domestic demand and consumption, they'll be okay. If they don't do it, then they're going to end up into very low growth and deflation like they are right now. That's the main challenge they're facing.
Thank you. Now, the question to you, Amitabh, based on what you said, I think that is the reason for the recent commission that we have announced towards improving ease of doing business further. But tell me, in the current situation, this current crazy times of not just Trump, but I think also the wars, et cetera, that you've highlighted, is it becoming more difficult for multilateral institutions or platforms like the G20 to bring voices together, particularly for the the global south? Are they a nervous lot today on account of what is happening in the northern part of the world?
So Shamika, let's first understand that at this roughly about 3% of the growth, 4.4% is actually going to come from emerging markets. That is, 70% of the global growth is going to come from emerging markets this year. And according to IMF, for the next 3 decades, emerging markets are going to contribute 70 to 75% of the global growth. And that's simply because of demographics. The population is very young in emerging markets, Asia, Africa. The population in America, Europe, China, all Japan, all aged or is aging, and therefore growth is going to come here. And therefore you need financial institutions which are restructured and multilateral institutions which are restructured to ensure that financial flows go into these parts of the countries where growth is going to take place. And, many of these institutions were constituted post-World War II when there was no challenge of sustainable development goals, nor there was a challenge of climate action. And therefore, these institutions are not able to mobilize private capital on the back of the equity that they have. So you're not able to ensure adequate flow of funds to these institutions. And secondly, to my mind, the United Nations has outlived its utility, much of what Prime Minister said the other day, simply because the Security Council is frozen in time, and new emerging powers, if India is the 5th largest economy and will go on to be the 3rd largest economy, doesn't have a voice in the United Nations Security Council. And therefore, to my mind, many of these institutions need to be radically restructured to provide for the new world order which is emerging. And that, to my mind, is critical. But having said all that, it's important that for a country like India to clearly understand the challenges. Last time, when United States walked out of the COP and the UNFCCC, China took that opportunity. And today it controls about 80% of the critical mineral. It controls close to about 75% of the EV market. It controls 72% of the battery market. It controls 60% of the wind market. It controls the solar market to a 72% market in solar, in all clean tech. People talk about Tesla, but forget it. BYD is controlling 23% of the market. So, and it's very, very important that with your growth is not going to come from traditional sectors of agriculture and food processing. You can provide jobs in textiles, etc., but the big growth is going to come from new emerging technology areas. And therefore, India needs to get into really big technology areas of growth. And that is going to be cutting edge areas of quantum computing. It's going to be AI. It's going to be, and I'm truly delighted that Tatas and Mahindras have come out with really top class EV vehicles, which to my mind the new Mahindra vehicles and Tata vehicles will actually are very, very top-class vehicles. So they can become a big source of exports for the rest of the world as well from here, and they're very price-wise competitive. So you have to get into battery manufacturing, you have to get into EV manufacturing, you have to get into many of these competitive areas of growth to be able to technologically pole vault. And that, to my mind, is very, very critical for India. And in the field of AI, we'll have to be far more nimble, far more cost-effective, far more energy efficient, and ensure that we build up multilingual, multimodal AI models. We've demonstrated our great ability in the digital public infrastructure. We've done what nobody else in the world has done. You know, from fast payments to credit to wealth creation to insurance, we do in 30 to 60 seconds. Nobody else in the world has been able to do what India has done. So we have this great capability within India. I mean, even in AI, you have about 500,000 engineers, you have 92% adoption rate, you've been able to provide, you are now going to provide computing power of GPUs at the lowest cost in the world to your researchers. So you have this great ability to technologically leapfrog with young talent, and that is what India should really push for.
We have 5 minutes. Perhaps we can take some questions from the
Hello,
audience.
ma'am.
Ms. Ravi on the
Hello.
right.
To your left. Hello, I am Pari Mirani. I am a law student.
Go ahead.
So my question is, with global uncertainties like trade wars, capital movement, and financial pressure shaping the economic landscape, how can emerging economies, including India, ensure steady growth? Should they focus more on strengthening regional partnerships, improving domestic resilience, or deepening global trade ties? Thank you.
Ms. Ravi on the right. Our question to Mr. Kant, with almost 25% of the tariff imposition that has been coming from President Trump, many people have been saying that this is a good news for India and probably a bad hawkish news for the Asian market. But I believe that people in India or people in New Delhi should be worried of this, because this exports of Chinese, the South Korean steelmakers, the Japanese steelmakers, which was going onto the Euro-Atlantic market, will it not be deviated into India again? And if it gets deviated to India, what are the remedies that the Indian government would do? Mr. Kant, question to you. Thank you.
Hello, ma'am.
Yeah.
My question is...
This seems really well orchestrated.
Yeah.
Good afternoon.
Yeah. My question is, in an era where policies heavily influence central bank policies, do you think the independence of monetary policy is at risk globally, especially in democracies? Thank you.
Okay. So perhaps, Nouriel, we can start with you. There were 3 questions. Please feel free to respond to any of them.
Yeah, I mean, if I had to start with, the last one, I do worry about the world in which there's a large amount of budget deficits and rising public debts, and also a world where there's a large increase of private debts. And if that happens, I think that if governments are unable over time to either raise taxes or cut spending to make those debts unsustainable, the path of least resistance might be to inflate the real value of nominal long duration debt, as long as in domestic currency, through unexpected inflation. So on the demand side, I think inflation may become higher because of debts and the need to reduce them through inflation. On the supply side, I think we've gone through cycles in the last 30 years. Initially, we had the great moderation, low inflation with independent central banks. After the stagflation of the 70s, we made central bank independent, inflation was low, growth was stable. Then the great moderation after the global financial crisis became the great secular stagnation, because the recovery of growth from the global financial crisis was weak, and we had deflationary or disinflationary pressures. So we had this period of secular stagnation. Then after COVID, we had the resurgence of what I call the great secular stagflation, negative aggregate supply shock, that increasing inflation reduced growth. And that's the risk we're facing, that geopolitics, deglobalization, restriction to trade, to migration, backlash against liberal democracy, and so on, so on. Climate change and other phenomena are going to increase cost of production, inflation, reduce growth. That's the risk we're facing right now. So inflation could be higher because of negative aggregate supply shocks and the need to wipe out the real value of debts. That's the bad news right now. We are still in this potential stagflationary period. As Kant was saying, growth has been low. The silver lining is that because of technology, I think that we may be moving from the great stagflation to a secular boom, because over time, technology implies not only higher growth, but disinflation and deflation is not coming from weak aggregate demand, like in the case of the secular stagnation, but disinflation is coming from increasing aggregate supply, so good disinflation rather than bad disinflation. We're not yet there, and we're facing a decade where these stagflationary forces are going to be dominant. But if we can control them and manage these shocks and then adopt technology, I think we are going to end up in a brave new world where potential growth is going to be higher, it's going to be exponential, and we'll have good deflation as opposed to otherwise. But we may have to go through a stagflationary period before we get to the disinflationary boom of the next decade.
Okay, so technology again.
To the response to that question, my mind that every crisis is a wonderful opportunity, and India must seize those opportunities. In several sectors, inputs and component costs which go into manufacturing the final goods, the tariff levels are high. We should bring them down to zero levels so that you can become a very integral part of the global supply chain. And to my mind, India needs to do several things. You need to do smart urbanization. You need to improve your learning outcomes, health outcomes. India will be providing 30% of the skilled manpower to the world. And you need about 12 Indian states. It's not just the central government. The 12 Indian states to have the hunger and the passion to grow at 10% plus. If 10 Indian states grow at 12 Indian states grow at 10% per annum, which is easily doable, considering the low base in the eastern part of India, you will have India growing at 8 to 9% per annum.
Thank you both. Now, to the audience, just as a quick summary, while we are in the midst of extremely uncertain times, but both the speakers, and frankly, I sense it too, that there are enough reasons for optimism, technology being a key driver. But also for a country like India, this is a rare opportunity which can become a turning point for us, where we also fundamentally change the way we are globalizing rapidly and connecting with the world. Also remember, unlike China, India's domestic demand is not a repressed demand, and hence that also becomes of extreme strategic value. So thank you all, and thank you for listening.